Hey, it's Matthew Decker here, Leveraged Wealth Management. I also run cash value life insurance reviews on YouTube. And what I wanted to do today was spend some time answering the number one and number two most common question that I get asked on almost a daily basis. We talk a lot about cash value life insurance, specifically for tax-free retirement income. And I would say the number one question that I get asked is, Matt, is this right for me? Is this something that I should be considering? And we spend a lot of time, dissecting policies and talking about the right way and the wrong way to structure policies. But what we don't spend a lot of time doing is coaching people on why this may or may not be something that they should consider. And so if you've ever seen, a cash value life insurance policy, whole life insurance, index universal life insurance, variable universal life, or just a standard universal life insurance contract, or maybe you think that the only life insurance that exists is term insurance. Okay, this video is going to be for you. My hope is that it articulates who should be considering cash value life insurance as part of their overall portfolio and why. So that's what we're going to tackle today. Who should be considering cash value life insurance, and maybe more importantly, why should you be considering cash value life insurance as a part of your portfolio? So I'm going to share my screen here and go through with you the things that I think everybody should be thinking about as it relates to taxes, retirement planning, and specifically cash value life insurance. So all you're looking at is just a blank screen, and I've got my little tablet here that I can write on. And so I'm just going to kind of walk you through this concept, cash value life insurance, for the purpose of tax-free supplemental retirement income. And the first thing that you have to understand is that the people that are looking at using this strategy, they all have one thing in common. And here's the one thing that they have in common. We ask them a question. And the question that we ask them is, do you think tax rates are going to be going up, or are they going to be going down in the future? Are tax rates going to be going up, or are they going to be going down in the future? And when most people hear that question, they immediately think, well, our government is basically broke. We have about $100 trillion of future unfunded liabilities. It might be upwards near 120 trillion at this point when you factor in Medicare, Medicaid, Social Security, defense spending, interest on debt. When you factor in all those things, total unfunded liabilities is north of $100 trillion. So you ask somebody, they think about those things, and invariably, all the people that are interested in this particular strategy, they will say, well, I firmly believe that taxes are going to be going up in the future, without question. So those are the people that are looking at this strategy as an alternative for some of their retirement funds. And so once we establish where someone thinks taxes are going to be going in the future, for them personally, obviously, if you're in the lowest tax bracket, you'll probably remain in the lowest tax bracket. But again, this is a strategy for high earners. So when we ask high earners, are your taxes going to be going up or down in the future? Most of them say, my taxes are going to be going up, and I kind of know that. So having said that, the next thing that we do is we try to talk about and think about, okay, well, what are the different types of ways that money can be taxed? And so I've come up with four main ways, and I put it onto a table, and I just call this our money tax table. And again, there's four types. The first type, and the most desirable type of money, is going to be free money. Now, why is this number one? Well, it's free, and so therefore we don't really care how it's taxed because, again, it's free. So we don't care how free money is taxed, and therefore it's top on the list. The second type of money is not free money, but rather tax-free money. And then the third thing on the list is going to be tax-deferred money. And the fourth thing on the list is going to be taxable money. Now let's give some examples of each of these just so we kind of understand what we're talking about and we can get kind of a full picture of where what you have and what you're looking at might fit in on this list. Obviously, the higher on the list, the better. So when we're talking about free money, the things that we're talking about are going to be things like gifts, inheritance, and really the big one, the one that you have control over, or some degree of control is going to be a 401k match. Not the 401k, but rather the matching portion of a 401k if you have one. Now, if you're a business owner, you really don't have any access to free money because a 401k match is your money in the first place. So it's not technically free money. When we're talking about tax-free money, there's really three main types of tax-free money that we're talking about, and that's going to be municipal bonds, Roth accounts, so this could be a Roth 401k or a Roth IRA, and then cash value life insurance. Those are really the three types of tax-free dollars that you could earn. Tax deferred is the big one. Most people understand what's tax deferred, so this is not an exhaustive list, but certainly there's a ton of alternatives here. So we've got your 401k, 403b, an IRA, SEP, simple, annuity, all kinds of options here in this tax deferred bucket of income. And then we're talking about taxable income. Really, we're talking about non-qualified stocks, mutual funds, and real estate. Those are the main types of taxable dollars. So obviously our number one goal as it relates to this particular list is to max out our free money, which really is going to come down to, if you have a 401k match, maxing out your 401k match. Pretty simple. Now, when it comes to the rest of the list, 2 through 4, tax-free, tax-deferred, and taxable, this is where you have some choice. This is where you're able to kind of choose which of these line items you start putting your money into. So really the question here becomes, when you get to retirement, you essentially have two choices for your money. And those two choices are taxable money and tax-free money. So let's zero in on those two options. So on the left, we've got all of our taxable money. Let's call this our taxable bucket. And this taxable bucket is split into two halves. In the left half of the taxable circle, let's throw all of our tax-deferred vehicles. So 401k, IRA, SEP, simple, 403b, TSP, annuity, all kinds of options here. Not an exhaustive list, but that's what we got. In the right half of the same circle, let's go with our taxable monies, the money that's basically taxed every single year on the gains. And so you're talking about non-qualified stocks, mutual funds, and real estate. Let's blow up our tax-free circle as well. And over here, this one's much simpler because there's less options. Remember, we've got municipal bonds, we've got our Roth accounts, 401k and IRA, and then we've got cash value life insurance. Those are the three types of tax-free money that exist. So the question becomes, as a high earner who thinks that taxes are going to be going up in the future, you have a choice as to how you invest your money now. And that choice really comes down between these two options. So knowing that you have a choice, which would you prefer? Now, most people that are looking at cash value life insurance specifically for tax-free dollars, obviously they're in this camp over here. They're saying, well, I'd much rather have tax-free dollars versus taxable dollars. And why is that? Well, it's because if you have taxable dollars, and really, when we're talking about taxable dollars, most people have the majority of their retirement funds sitting in one of these accounts over here, one of these tax-deferred accounts. The biggest one obviously being 401ks and IRAs. Now, if you're a business owner, maybe you're SEP or simple, but the majority of people have most of their retirement money in tax-deferred accounts. And it's important to understand then how these tax-deferred accounts are taxed. And it's really simple. These tax-deferred accounts are taxed at ordinary income rates. And when are they taxed at ordinary income rates? Well, they're taxed at ordinary income rates when you actually go to take the money out of the plan. And so that could be 10, 20, even 30 years down the road.
which is actually pretty scary if you think about it, because what's the purpose of putting money into all these tax deferred vehicles? Well, hopefully the purpose is for that money to grow over time, right? You want your money to grow over time. But again, remember, most of the people in these high tax brackets that are earning a good living, they think that taxes over time are actually going to go up. So what do you have? You have a vehicle where the goal is to grow your money over time, and you're going to access it 10, 20, or 30 years down the road, and yet you think that taxes over time are going to go up. So what are you left with? You're left with a vehicle that gets bigger and bigger and bigger while tax rates go higher and higher and higher. And what you're actually doing in terms of taxes is you're making the problem worse, because you're going to end up paying taxes at a higher rate on a larger sum of money. And from a tax standpoint, you've just compounded your problem. So once most people realize this, they try desperately to get as much of this money over into the tax-free bucket as possible. So let's go over the options in the tax-free bucket of income. And let's just go ahead and start with municipal bonds. Typically, a municipal bond is going to have a relatively low yield. The income off of the bond is definitely going to be tax-free. If you sell the bond, it's not tax-free. In most cases, you are investing in state and local municipalities, which some people don't like because they don't have faith in some of their state and local municipalities. Personally, I grew up near the city of Chicago, and that is one of the last places that I might want to purchase a municipal bond from. There's several municipal bonds that have defaulted because of creditworthiness. But for me, the bottom line on municipal bonds is, with the low yields, unless you are a multimillionaire looking for a relatively small stream of income that's tax-free, municipal bonds are not the most efficient way to max out your tax-free dollars. So most people look past muni bonds. Let's key in on the Roth IRA, or the Roth accounts in general, 401k and IRA. If you have a Roth 401k at work, that is absolutely, in my opinion, the 401k option that you should choose. It is much better than just your traditional 401k account. And if you get a match on your Roth 401k, even better. You should absolutely max out the 401k match through work. Most people do not have access to a Roth 401k at work. Most people, when they think of a Roth account, what they're really thinking of is just the Roth IRA done outside of work. So there's a couple things we need to understand about the Roth IRA. Number one, there's an income limit. So the IRS comes in and they say, well, you make too much money and you can't contribute. And if you are married filing jointly, the phase out limits start at $193,000 per year. So you make more than that, they start phasing out your ability to contribute. Aside from there being an income limit, there's also a contribution limit. So no matter how much money you make, the most that you can put into a Roth IRA on any given year is going to be $6,000 a year if you're under 50. And $7,000 a year if you're over 50, and this is the 2019 limits. Another thing to be aware of in the Roth IRA is what's called the 59.5 rule. Now the Roth IRA is awesome. They give you access to whatever you put into the Roth IRA tax-free without any penalties at any point in time. But you can't touch the growth on your Roth IRA until you turn 59.5. If you do touch the growth on your IRA before you turn 59.5, they assess a 10% penalty. Now, obviously, there are some exceptions to this rule, things like buying a first home, some extreme medical scenarios, but by and large, there's only like 3 or 4 exceptions to this rule. If you try to access your gains before 59.5, you do have to pay this 10% penalty. So that's just something to know. You don't have full unfettered access to all the money in your Roth IRA. And the last thing with Roth IRAs is that most of them are going to be backed or invested in mutual funds, which means that most Roth IRAs are subject to a great deal of market risk. Now, there are exceptions to this rule. You could put an annuity inside a Roth IRA. You could do a Roth annuity. There are some other instruments that you can put in a Roth IRA to avoid market risk. But for the most part, if you have a Roth IRA, chances are it's invested in mutual funds, which means it's going to be subject to market risk. So that's the Roth in a nutshell. Now, this whole video is around the concept of tax-free retirement income using cash value life insurance, and we have yet to say anything about cash value life insurance. So let's talk about cash value life insurance for a second and why this is one of the preferred methods for generating tax-free retirement dollars for high earners. And really, it's pretty simple, because the key here is high earners. When it comes to cash value life insurance, there is no income limit in terms of how much money you make per year. You can make $1 million a year, $10 million a year. No one is going to tell you how much money is too much money to be able to contribute to cash value life insurance. So for high earners, right off the bat, it can make more sense than a Roth IRA. There's also no contribution limits. Now, there are limits that are set by what's called TAMRA, TEFRA, DEFRA. Those are some legislative rules that were written back in the 80s that dictate how much money can go into life insurance and it still get all of the tax benefits that we know and love. But there's no one capping your yearly contributions into life insurance. So I've seen people pay $2,000, $3,000, $4,000, $5,000, $6,000, $7,000, $10,000 a month into cash value life insurance policies for the purpose of tax-free retirement dollars. There's also no 59.5 rule. So this is not an ERISA plan. This is not governed by any retirement legislation that's out there. And so what that means is you actually have access to all the money inside your cash value life insurance plan before age 59.5 without penalty. So that's pretty cool. Now, the cash value life insurance policies themselves oftentimes will carry surrender charges, but it has nothing to do with taxes and the IRS. So unfettered access to your money before age 59.5. And last but not least, and really most important to me, the reason that most high earners are looking to cash value life insurance instead of municipal bonds and Roth IRAs for their tax-free retirement dollars is because cash value life insurance is not subject to market risk. And so for high earners that already have a lot of dollars in things like SEP and simple plans, 401k plans through work, or large mutual fund portfolios or stock portfolios, for those high earners that already have a majority of their money at risk due to markets, this can be a great way to diversify from market risk and yet still get the tax-free dollars that most high earners really want in retirement. And what's really cool is not only does cash value life insurance generate tax-free retirement dollars without being subject to market risk, but when you actually compare a properly structured cash value life insurance policy, as I said in the intro to this video when I was sitting in my dining room, there are so many bad agents out there that do not structure these the right way. They structure them in a way to make maximum commissions off their clients, and in turn, that actually hurts the performance of the policies for the clients. So, major caveat, major asterisk, if you have a policy that is structured the right way, meaning minimum commissions, maximum cash accumulation, they're really difficult to beat from an income stream standpoint. And I'd like to kind of show you exactly what I'm talking about. So this is a really cool tool that lets us to compare several vehicles to a cash value life insurance policy. So let me just explain what you're looking at here. This is an individual who is in the top tax bracket at 37% federal, doesn't include state taxes, just federal. This is a 48-year-old male who's paying $3,000 a month into 3 different vehicles. The first one is just going to be a tax-deferred IRA, And we are forecasting that tax-deferred IRA at 8% per year growth with no market losses, okay? Just 8% per year growth. We're also comparing it to a Roth IRA. Now, if you were paying attention in the last little section, you'd know that you actually can't contribute $3,000 a month to a Roth IRA. But let's just assume that you could. If you could contribute $3,000 a month to a Roth IRA, earning 8% per year for life, how would that look? Now, the Roth IRA is column 3A and 3B. The IRA is column 2A and 2B. And then the 4 columns on the right, this is our cash value life insurance policy that is asterisk structured the right way. So this is our cash value life insurance policy that's structured the right way. And you'll notice we're actually running this policy at 6.64%. So almost a full 1.5% lower than the other 2 accounts. That's important, okay? We are not structuring this in favor of the life insurance. In fact, we're structuring it in favor of the other 2 accounts. Now, what's really important to note about these other 2 accounts that we're looking at, the IRA and the Roth IRA, is think with me for a second about this 8% yield, because we are showing 8% forever, every single year. Now, number one, you're a smart person and you know that that's not going to happen. It just won't. It's impossible. You're not going to get 8% on the nose every single year. But beyond that, you're also not going to shoot for an 8% rate of return once you get into your 60s and 70s, because an 8% rate of return carries with it an amount of risk that you're probably not going to be willing to take, especially once you start withdrawing funds. Most people will structure their risk to a point where their upside's going to be between 4 and 6%, not 8%. Because if you're shooting for an 8% rate of return, there's a degree of risk there that most people in their 60s, 70s, 80s, 90s are just not comfortable with, especially when you're taking out money. Any money manager would tell you that once you get into your retirement years and you're taking money out, you need to be shooting for a lower rate of return, maybe something between 4 to 6% due to the risk. Now, we are not doing that. We're actually assuming that every single year you get 8%, even in your 60s, 70s, and 80s, when your risk profile is going to change dramatically. So I just want to reiterate, this is completely weighted in the favor of these 2 accounts right here, the IRA and the Roth IRA. And even then, it's incredibly surprising. So check this out. So $3,000 every single month is going into these 3 policies. And what we're going to do is we're going to turn on a lifetime stream of income starting in the 22nd year, age 69 in this case. It doesn't matter when we do it. We just chose age 69 for this example. And what this software is going to do is it's going to calculate the maximum income that we can take out of the life insurance policy tax-free, and that happens to be $162,000 per year. And so what the software does is it says, well, if we can take out $162,000 a year from the life insurance policy, how much or how long can we take this same $162,000 a year out of these 2 accounts, the Roth and the IRA, assuming we can get an 8% rate of return? How long can we take out the same income, assuming an 8% rate of return from these 2 accounts? And you'll notice all of them are taking out $162,000 a year on this page through age 77. And that continues on to the next page, $162,000 a year. And you'll notice we can do that in the life insurance policy all the way to age 100. And we still have $500,000 left over. We still have over $500,000 death benefit. In both of these other accounts, we run out of money at age 83. Now, there are a ton of reasons why this is happening. We don't have enough time to go over all those reasons in this video. What's important here is if you were trying to match the rate of return from the cash value life insurance policy, rather, if you were trying to match the income of $162,000 per year, you would have to get over 10% every single year in these 2 accounts in order to match the income that's generated from the cash value life insurance policy. And I don't need to tell you, shooting for a 10% rate of return when you're 75 years old is absolutely insane. No one would recommend that you do that. And so this, coupled with the risk profile that we're able to generate in the insurance policy, where we're shooting for a 6.64% rate of return, and again, we have no market risk here, and this return is achievable in these policies if properly structured. The fact that we can generate more income for longer with less risk and no market risk, and it still all be tax-free, that is the reason that tons and tons of high earners are actually looking to cash value life insurance for their tax-free supplemental retirement income. Now, does that mean that you should run out and buy a cash value life insurance policy? No, that's not what it means, because this strategy is not for everybody. But I think you can see why it's at least appealing.
If you're interested in exploring cash value life insurance as a supplemental retirement income in more detail, here's what I would encourage you to do. Because again, I said this isn't for everybody, but for a certain set of the population, high income earners looking for areas where they can put money that's going to grow tax-free, it's going to come out tax-free, and it's going to be considered a semi-alternative asset class, not correlated to market losses, then what you need to do is set up a time with somebody that can point you in the right direction. Now, I would tell you that we can absolutely point you in the right direction. We see thousands of cash value life insurance policies every single year. People send us their policies to review on a daily basis. And so if you have a policy that you want reviewed, you can send it to us and we'll do that for you. We'll tell you if you're on the right track or if you're on the wrong track, if it's designed the right way or if it was designed the wrong way. If you're looking to explore this as a part of your overall portfolio, as a part of your overall strategy, either for retirement or accumulation or taxes, then I would encourage you to also book a call with us. The way that you can do that is you can go to our website, leveragedwm.com/contact-us. You'll see a calendar page there where you can actually book a really short 20 to 30 minute discovery call with us. We can go over your goals. We can go over, what you're hoping to achieve. If you already have a policy, we can discuss the policy that you do have and talk about next steps and ultimately find out if this is something that's going to be a benefit to you overall or if it's not. And this isn't a benefit to everybody. It really does depend on a couple things. Number one, your age. It depends on your health status. It depends on your timeline. How long until you're hoping to turn one of these cash building life insurance products into some kind of income stream or payout. So what's your timeline like? And then how much are you looking to contribute on an annual basis? That actually matters. You get economies of scale at certain death benefit amounts on these life insurance policies. And so if you're looking to put away, a couple $100s a month, this probably isn't the right way to do that. You'd be better suited in a Roth IRA. If you're looking to put away a substantial sum of money, then this often does become really the best place for tax-free supplemental retirement income, because you're probably not going to be able to get really large sums of money into things like a Roth IRA, and most people are not looking to municipal bonds for large sums of investable dollars unless they're already well into retirement and have way more than they need to sustain a relatively small income stream. So I'd encourage you to go to our website, leveragedwm.com/contact-us, or you can check out the link below in this video and it'll link directly to our website and calendar. We can have a really short call. We can talk about whether this is the right thing for you or the wrong thing for you. But you should know that one of the tenets of our company is this. We want to help give you enough information and education so that you can feel comfortable making a decision that's best for you. That's the goal of everything that we do here, give you enough information and education to where you feel comfortable making a decision. And no matter what your decision is, we part friends because we are way more interested in doing what's right for people and getting people the right things for their particular situation versus just selling a product or pushing a product. It's way more than that. So I'd encourage you to go to our website, check us out, book some time with us, and I can't wait to talk with you then. Take care.